was the government trying to test market reactions, trying to give, like, not to dump all of this information at the markets in one go and see how they react. And it looks like broadly that has worked. So market reactions are smooth. Long-term gilt rates have barely moved. FTSE 250 has barely moved. The AIM has just had quite a large bounce in the last half an hour or so. We were talking earlier, actually, almost certainly because it's fallen by about 15% in the last 3 months as everyone is pricing in the total removal of inheritance tax exemptions for AIM, so the outcome is not as bad as everyone feared. So from a macro point of view, we don't need to worry about comparisons to trust budget and all that kind of stuff. The markets have taken the additional borrowing in their stride. From a growth perspective, I guess probably one of the main things to take out is there's not a lot of revisions to those numbers. So there's definitely a very small boost to growth over the short term, 2025, 2026. There are now write-downs to growth further out in the forecast horizon. So there's an expectation that some of the stuff that's been announced today is likely to give some short-term tailwinds and supports the economy over the next 2 years or so, with rather less than was already penciled in over the next few years. Now, I think there's going to be some challenges to that. And the one thing is, most of that growth spurt that the ABR's is balancing up in the next 2 to 3 years is predicated on this huge capital investment spend. So the idea that you can get £22 billion worth of revenue spending into the NHS and spent in the next 18 months is a hell of a challenge. So one of the things with investment spending, constant challenge with politicians, as businesses, you'll understand it, is they just magic up the number and put the money on the table, assuming it will just work its way through the system and do its stuff. So can the NHS absorb 22 in revenue in one go? Well, maybe. Can it do it well? That's a very different question. Then there's a whole load of construction stuff, essentially. So capital investment into schools, capital investment into hospitals, capital investment into roads, the 1.5 million housing target. All of this stuff assumes a response from the construction sector, which on all evidence we currently have today is not deliverable. There are not the people sat around waiting to go. The construction sector is in a pretty grim position generally in terms of margins and outturns. So I would worry that the growth forecasts projected are unlikely to materialize because you're just not going to be able to spend this amount of capital this fast, essentially. Now, household incomes aren't forecast to move very much. Clearly, there's going to be a negative impact in terms of salaries. So I'll let you talk about the tax stuff in detail. From the economics of tax, employer NI is a payroll tax. It falls almost entirely on the employee. You will all shuffle your tools inside your businesses to essentially take that money back out of their pay packet. Depending on who you are, your sector, all the rest of it, the speed at which you can do that will be different and how much that goes to. But ultimately, it's going to fall on households because there's no one else to pay any tax. So that's going to be a bit of a worry in terms of household disposable income and where that goes for the next few years. I think in terms of where in the business community this hits, we've seen the doubling of the, the employer allowance for national insurance to 10,000 something. So for anyone with an NI bill of under 100k, presuming the exemption threshold stays in place, I've not got that far in the documents yet, then there should be no impact to a positive impact. I'd be worried about anyone who's just over, or indeed over the £100,000 total NI bills. That's what a salary bill of, you're the accountant, 1.5 million, 2 million-ish. You're going to essentially take the whole of the employer NI burden. You're not going to get access to any of the employment allowance relief. And if your workforce is made up of minimum wage or only just minimum wage people, you don't have the mechanism to pass that through into their salary because government is mandating that you lift that. So for me, that's where the burden of all this is going to fall. So that is kind of prime, what kind of large scale, micro, small end, medium, in terms of where that burden sits. I'm not sure I have anything else to say at this point. There's like 1,000 things running through my head. So it's on the scale we expected. 40 billion in tax rises, 70 billion or so in spending. I think the big question really is the bit that's still unanswered and will be unanswered until March is what this means for the slightly longer term. Rachel Reeves announced a number of measures, some which will kick in immediately, stamp duty, which makes sense to do it immediately because otherwise you've distortions going on, mostly to either top budgets up in this financial year or to prepare the first year of the next spending review from April 25. What happens beyond that, we still don't really know. We're still waiting for the spending review will come forward in March, which will give us that detail. But I've heard a number of you saying, the good number heads in the room, and I agree, there's something missing. The sheer amount of tax rise and spending stuff, there's something. So if I can, I'd quite like to pass to you while I see if I can, if I can find out where something doesn't quite smell right.
Thanks, Christian, I think. I mean, yeah, just to echo what Christian said, I think from a tax point of view, it's employers who are coming in for the real hammering here. So smaller employers, obviously, if they've got a relatively small wage bill, the increase in the national insurance employers' allowance will soften the blow or actually leave them in a net positive situation compared to where they are at the moment. But I did and my maths is terrible, so don't rely on this or quote it. It's not great for a tax person, is it? But if you've got somebody on 30,000, I think the current NIC bill at 13.8% and a nil rate amount of 9,500 is around 2,800 for them. That'll go up to 3,750 for an employee on 30 grand a year. And for somebody on 60 grand a year, it's currently just shy of 7 grand. That'll go over to go to sort of 8,250. So they're, for people with businesses with large populations of employees,
1.5 to 3% increase.
It's a massive, really, really significant cost. Which, when you think that you've now got, as sort of as Sarah said, the national minimum wage now, going up by 6% but also aligning it so you're going to ultimately have a single national minimum wage for all adults, means that again employers are just bearing more and more of the burden here, and how's that going to impact on people's recruitment decisions over the coming years? And ultimately, one way or another, that is going to find its way to the consumer through increased prices, because businesses are going to look to adjust prices or reduce employee numbers in order to actually maintain their profitability. From a business exit point of view, valuation is going to be impacted because profitability is going to be down as well. So there's a whole raft of kind of, hopefully consequences that have been thought through from these changes, but I'm never completely convinced just how far the thinking process actually goes. That may be unfair, but I've watched enough budgets over the years to be fairly confident it doesn't always go as far as it should. The other big ticket items are obviously capital taxes, and capital gains tax, as I think a lot of us probably had got to suspect, it could have been worse. It could have been a lot worse. Sort of 39% was a number that was obviously floated out there just to see what the reaction was. The reaction was, absolutely appalled, and therefore we've now got a top rate of CGT of 24%. I've just had a quick check on the Treasury website, and again, this is just an initial take, but I think that's effective from today, the 24% rate and the 18% rate for basic rate taxpayers as well. The 18% rate, that's a significant increase in percentage terms, but the actual level of gain that impacts tends to be quite low, because it's only really relevant where people have got income below the basic rate threshold anyway. The positive news, business asset disposal relief, hands up if you're looking at Sarah's checklist there. I thought that would go from today. So we've still got it, and that stays as is until April. But then it goes up to 14% next year and 18% to align with that new lower rate of CGT. So there's still some reward in terms of reduced tax rates for people selling entrepreneurial businesses. And I think, potentially, let's be honest, BADR, in terms of what it actually saves you, that 4% increase for any individual is a maximum cost of £40,000, right? Because it's the lifetime limit of £1 million at 4%. So for somebody who's doing a pretty significant deal, that's not something you're going to sweat over. But if somebody's selling their business built up over years and they're only expecting to pay 100 grand tax on, say, £1 million gain, to suddenly have another 40 grand going out as a consequence of this, and then 18 grand in 2 years' time, that's a big old hit. That is something that is going to hurt. But is it actually? I think, again, it's just about, and Charlotte in the room is very good at saying, just reset your expectations and understand what that means in terms of what you actually have to achieve in order to get back to the same net figure that you would have beforehand. So at least we understand it now, we know what it is, and it's nowhere near as bad as it could have been. So I don't know whether the queues of people at Manchester Airport waiting to get on the flight, the flights immediately after the end of the speech have dissipated to a certain extent, perhaps so. Again, on capital taxes, I can't remember. I think I was probably at school the last time that the inheritance tax nil rate band was increased. So, it's been 325 grand for as long as I can remember, and it's going to stay that way for a while yet. Still, and it's a classic example of what people like to call fiscal drag. Just by virtue of the rate not moving, it drags more and more estates into IHT over time. And for those estates that are over, it increases the amount that they're exposed to IHT. The big ticket items there, inherited pensions into IHT, that's a massive change for particularly, people with big pension balances where they've relied on being able to pass that down to the next generation, inheritance tax free. I think from April 27, that's going to be in your estate from an IHT perspective. Whether that changes people, I mean, there's a few people from wealth management businesses in the room. I think it'd be interesting to get their perspective on, over time, how that's going to impact on people's strategies in terms of pension savings and inheritance and stuff like that. The other thing for the business owners in the room, I don't know if we've got any farmers in the room who are affected by agricultural relief, but there's certainly business owners in the room who are going to be affected by business relief. And that's, again, a big change. So the expectation up to date has been that if you own a trading business, you can pass that on in your will, and it's entirely inheritance tax free. We've now gone to this situation where effectively, if it's worth up to £1 million, it's still inheritance tax free. If it's worth over £1 million, there's going to be 20% inheritance tax on that excess over £1 million. Mm-hmm. How that's going to be funded is a really interesting and challenging question. There may be no option but to raise debt on the business or even sell the business in order to pay the IHT liability. The whole point of BPR was to avoid that impact by people having to sell businesses in order to fund the inheritance tax liability. I would expect there's certain assets like property, you can spread the inheritance tax paid over a number of years. I would imagine that will be the case on this, but you are still going to have to find the cash to pay that. So again, in terms of people's succession plan, if it is a family succession type situation, it's going to radically change the way that they should be thinking about how they're going to pass that business on.
Yeah, that's usual for this kind of thing.
BADR doesn't. I think that's still till April, but the rates are going from today. I think other things that kind of stuck out for me, the corporate tax roadmap, and I always a little nervous when people say they've capped the corporation tax rate at 25%. Well, it's capped at 20. It's 25% at the moment for businesses making over 250 grand a year. 19% for businesses who are making 50 grand a year. Mm-hmm. Capped at 25% implies to me that there's wriggle room potentially for them to increase that 19% over time. And I wouldn't be surprised if we get back to a unified rate of corporation tax at 25% over the lifetime of the Parliament. What else? No changes, no extension to the freezers in the income tax threshold. So from 28-29, it's going to go up by inflation as it has done in the past. But 28-29 is a long time away, and nothing's forever, is it? So there's every possibility that this time next year they might say, well, actually we need to freeze it now for another couple of years. Cool. You may think I'm cynical, but you don't do tax for as long as I do without becoming a little cynical, unfortunately. The other thing that in one sense is heartening, I think, is this commitment to modernise HMRC systems. Now, if I could, a bit like BADR, Entrepreneurs Relief, I've had a pound for every budget where they've said they're going to improve HMRC's performance, and we've seen absolutely no impact from that performance improvement. They're talking about more compliant staff. They're going to go after umbrella companies, which I think is these are companies where effectively, they almost force people into behaving, treated as if they're self-employed, effectively, and they keep all of the NIC savings. So it is pretty insidious, some of that stuff, when it's done badly. So I'm, in a sense, I've got a degree of sympathy with going after people who are promoting tax avoidance schemes. It's just where there's always a slight nervousness about where that line about what's legitimate tax planning as opposed to what tax avoidance is, and where that actually sits. And over time, you've definitely seen HMRC trying to push that line closer and closer to what we would consider to be perfectly standard, legitimate tax planning.
Yeah. Can I add a little bit to that?
Of course.
On that point as well, I think the other challenge here is these. Well, the employer NI changes that we've seen have essentially increased the tax differential between employment and self-employment or worker status gap. So the government has increased the incentive for you to try and come up with a way of disguising employment. Simultaneously, of course, the next bit of legislation on the whatever the working conditions bill is like to be called, wants to abolish worker status.
Okay.
So there's going to be an interesting bit of interaction about how on earth all of that goes. Abolishing worker status from a sheer economics point of view is a really good thing to do, because it's from a legal point of view, it's odd because it's a case law thing. Parliament has never called for a worker thing. It's a result of judicial action. So that needs tidying up, but that's going to be really hard, right? I mean, expect very long consultations about how to abolish, because if you're going to abolish worker status, you have to make the employment self-employment distinction crystal clear. And you've just provided a fiscal incentive to try and route people into self-employment, essentially. So there's going to be some mess around that.
I mean, it's a mess already at the moment for anybody who's trying to navigate. So you may have heard of what generically known as the IR35 rules, which is this distinction around somebody who's working for through their own company. Are they actually a contractor, or are they really an employee? And we've had Heinz 57 different varieties of tax cases, largely around BBC news presenters, but also high-profile sports people. And it is virtually impossible to kind of draw a line and say, well, okay, I understand why that one was treated as employed, whereas this one wasn't. And yet employers, who are sort of medium-sized entities and above, are expected to make a judgment around that and decide whether this person who's providing their services through their own company is actually a deemed employee or not, when even judges in the High Court and the Court of Appeal and the Supreme Court can't work out how that works. So to Christian's point, we've now got a much bigger incentive for people to say, well, do you know what, I'll give it a go, because that's going to save you 15% employers' national insurance rather than 13.8% employers' national insurance. So we've turned what is already muddy waters into a swamp, as far as I can see. So that is going to be a real challenge. Interesting one, they're going to increase the interest rate on late pay tax. There is a tendency for certain businesses to treat HMRC as though they're a bank, because their lending rate's actually lower than the high street banks. So I think from that perspective, that's probably actually a reasonably sensible change, because we don't want to give people a reason. If the HMRC's interest rate is less than your cost of capital, then why bother paying your tax? You might as well borrow off HMRC. So I think, in one sense, that's not necessarily a bad move. There were one final thing, and sorry, this is a little bit eclectic, I know, so apologies, there's no particular thread. I just looked in the documents, and there's a mention about some anti-avoidance rules about preventing people from extracting untaxed funds from their companies. Now, I don't know how you can extract untaxed funds from you, so I'm obviously missing a trick here. So, but apparently they're going to bring some anti-avoidance rules in to stop that. Now, I wonder whether that relates to things like we've seen a raft of MVLs, where people have built up cash in, many members' voluntary liquidations, where people have built up cash in businesses and are now taking it out of capital gains tax rates by liquidating the company. There are some anti-avoidance rules around that already, but they're not well enforced, and they're quite easy to navigate around. So it could be that. It could be things like I don't know, alphabet shares could be something around that. We know that that's something that HMRC have never really looked at in the past, but you're going to have to start reporting on differential dividends on share classes and things like that in the near future. So I do wonder whether we're going to see a tightening up around some of this stuff, which could impact things like family investment companies, for example. So there's a classic taxman's way of trying to avoid getting into too much detail. The devil is all going to be in the press releases. So the one good thing is I've got something to do while Mrs. Brown's watching Married at First Sight this evening. I can go and hide away and read through all the press releases, and hopefully I feel my IQ reducing every minute I'm in the same room as it, Louise. So
nothing there about pensions, actually.
No, nothing that I heard. Now, whether that's something that didn't warrant a mention, but you would have thought if it was going to be there, it would have warranted a mention. Because that, again, was something where, if we look at Sarah's little list, I'm sure I've probably got that on there as well. So I think it's probably just as well we didn't hand those out, to be honest, because I wasn't right on a lot of things. But, well, yeah, I tend to look on the dark side, and, so anything beyond that's an improvement. But I think, yeah, interesting one, Brian. I think that was something that did seem to be quite in focus, but bringing pension pots into IHT is going to raise a decent chunk of cash. Well, and this is it, and this pension fund, don't underestimate, because if you think that 325 isn't massive, right? Even with your main residence and £1 million between a married couple with your main resident nil rate band. If you've got a decent sized pension fund, there's a lot of estates that are suddenly going to find themselves in inheritance tax where they weren't previously. And you can only assume that there's going to be something that says that effectively you're allowed to dip into the fund in order to extract the funds to pay the IHT, I would imagine. Because again, where else is the money going to come from?
Given, I wasn't sure whether it was HMRC or other bodies, the ability to go directly into bank accounts.
That was for welfare.
Yeah,
stuff.
It's welfare stuff. Yeah.
So if they've got the ability to do that, but for welfare, there's every reason that could be.
It's hard to justify only doing it for welfare and not to justify doing it for tax debt.
Yeah. It's just it's way again. Was it around fraud, or was it just effectively unpaid debts? I can't. Yeah, but how do you define fraud? We think how long a fraud case takes to go through court, then so a lot to unpack. I think I think a lot of us had kind of got to the conclusion that they were making it sound like it was going to be the end of the world. So actually, when it was only appalling, then we'd all feel like it was actually a bit of a relief. And I think that's possibly where we've got to. It certainly could have been worse, but I think there's a few things in there where it's easy to kind of brush it off, but when you start to analyse what it actually means, the impacts could be much more far-reaching than we possibly realise at this stage. And my favourite expression, the law of unintended consequences, is almost certain to kick in somewhere along the line.
Does anyone have any questions?
How'd you cope?
I promised them an engaged, interested audience.
That's from April.
From April.
Yeah.
Yeah, no, from April. Also, actually, you didn't mention it in the speech, but it's here in the documents, is the £100,000 employment allowance limit is going to be abolished. So all employers will have access to the 10,500.
Which softens the blow.
It takes a bit. Well, I think for anyone who's right on that, it's a really big.
It is. That's a massive thing for bigger employers. It's a bit of a help, but not a lot. But it's a positive. It has to make sense, right? In that context. But no, I think it throws the whole estate planning thing massively up into the air. Yeah.
Yeah,
it never.
And it was combined.
Yeah.
Yes.
Yeah.
Yeah.
And that's really relevant for farmers, because where farmers tend to benefit from business relief, they'll get agricultural relief on the farm, but if there's hope value because there's, say, development potential on the land, they'll get business relief on, because agricultural relief only applies to, this is really sad techie stuff now, isn't it? Agricultural relief only applies to the agricultural value, which is about 10 grand an acre for agricultural land. If you've got development potential on that, you get relief on the excess over the agricultural value by way of business relief. So if a farmer's got development land and they die before it's developed, but there's massive development potential in that again could result in a really significant IHT cost if they're going to pay 20% on that excess value.
I mean, the other aspect of that, I guess, is as part of the proposed planning reforms, one of the things government wants to investigate is the entire idea of hope value. And whether to just strike it out.
Right.
Most of the countries have over the years have got rid of it. So from government's point of view, it's more to do with the compulsory purchase order side, which essentially enables land to be CPO'd at its agricultural value, not with hope value.
Yeah.
But it may well have inheritance tax consequences.
On valuations as well. I can only imagine it will. There's going to be a lot who are just bubbling under at the moment who are going to be tipped over.
Yeah.
No, I think, look, I think that again is probably, it's the fiscal drag thing combined with, suddenly bringing what is, a lot of people's second biggest asset will be their pension fund after their house. So suddenly bringing that into the IHT net, and by the way, if you're a business owner, bringing a massive chunk of value from your business, into the IHT net as well. Suddenly we're going to have an awful lot more people who are paying IHT. It's going to, in the past, it was not quite a joke tax, but it was a tax that nobody really worried about unless you were a big landowner, for example, whereas, slight exaggeration, but when 325 grand was actually worth 325 grand, then that was a lot of people out of the IHT net. So just the fact it had the threshold hasn't increased, and then bringing more and more stuff into the net means that suddenly a lot more people are going to need to be thinking about IHT planning. And a lot of those people, with the greatest respect, are not going to be people who have ever had to even worry about IHT in the past. Exactly.
Yeah. I mean, yeah.
So
the old line that IHT is a tax on the unprepared middle classes, continues to sort of work its way down the distribution.
I think that's absolutely the case.
I might have got this wrong. You marry that up with $2 billion on capital gains.
Yeah, well, I mean, Christian, you tried to explain it to me in simple terms, but from an individual's point of view, things like BADR are very significant from an economic point of view.
Yeah, from a national economic point of view, they're irrelevant in terms of the money they raise. From a sheer economic theory point of view, you will find no economist of any political persuasion who doesn't say scrap BADR, scrap it. Because there's whilst it's huge, if you get to have the relief, that's lovely, and if a politician's going to come and take it away, you'll be furious. There's no evidence that it provides any incentive for people to do anything with businesses. That's the kind of the point. So you like it, anyone who receives it will be delighted, but economically, no one starts a business or grows a business because BADR is available. Right? It's just we call it a post hoc kickback, essentially. Oh, you find out it's available and you claim it, but it hasn't. The fact that it's there hasn't really changed your economic behaviour in any way. So the economic view on stuff like that is just scrap it because it doesn't really work. But that's a much harder argument for a politician to make at a dispatch box than it is for a dry old economist.
In the short term.
So the evidence generally is, so there will be, at the margin, some people will make kind of different decisions if you're coming up to liquidating it. Over the long term, is that what else are you going to do?
And like I think Paul said, actually the 10% to 14% grand scale of things isn't huge, but there will be a lot of people that will be focused on that numbers going up. more quickly.
So I think there's the temporality of those things. The other bit I think is how this is a bit we can never get politicians or civil servants in Treasury to think about is how different bits of the tax system interact with each other. So with some of these CGT changes and with some of the changes to IHT and business reliefs in inheritance tax, these numbers are starting to get quite close together. So there's definitely potential for, do I liquidate or do I let the estate handle it? Do we liquidate before death? Do we liquidate with family, or do we hold and allow stuff to flow through the IHT channels instead? When there was a very big difference between those two taxation regimes, your answer to how you would do that is fairly straightforward. Those regimes look more and more similar now. So actually, you might choose to say, actually, well, just let it go through liquidation. And then the economic effects of that are businesses that should be passed to someone who can run it better don't get passed to someone who can run it better, and assets get locked in. That's kind of the economic argument about that stuff. It's really why generally economists are generally in favour of things like heavy business relief exemptions for passing on, because the whole point of a business is it can last longer than the lifetime of an individual. So it's the business longevity you want to protect. Better to have its future profits in corporation tax than chase CGT now.
You said about the swing from obviously self-employed to employed. Group selling the businesses. I was looking in there about that.
Yeah.
0% capital gains on those.
That's a really tough one. Does an increase in 4% from 20 to 24% push people down that road? I think over time we're starting to see some of the fundamental challenges with EOTs and what people living with EOTs and finding them to be not quite, what it says on the tin. I mean, even the name's wrong, right? It's not an employee ownership trust because the employees don't own anything. So it's, I can't see it. I think if it's 20% enough to make you think I'd prefer a 0% tax rate, then 24% will be. Is 24% going to tip you over the edge to think that's the way you want to go? You tend to get a lower price from an EOT than you would do from a trade sale. So, look, I don't know is the honest answer. Yeah, no, I agree with that.
I mean, EOTs are still a form of an MBO.
Yeah.
Business has still got to fund it.
Exactly the point, Charlotte. Yeah.
What's underlying all of this is businesses are now going to be profitable. It's going to be harder for them to raise debt.
Yeah.
It's going to take longer for those EOTs to be paid down. So the same problem still exists.
Yeah.
And like you just said, it doesn't result in long-term sustainable businesses. Ownership of those businesses will actually become owners.
No.
And they then can't sell the business on in turn, so they're never going to be sold. So there's an even more increased risk of those employees who are now owners of the business walking away, and the original founder having to get back involved to save the business.
I think that's perfectly true.
The mechanism to get your money out tax-free, but it's still an MBO. There's still a lot of complexity around how you actually extract cash from
and a lot of risk, as you say, because the tail on deferred consideration is going to get longer because the business ain't making as much cash to be able to pay out, whether it's an MBO or an EOT. I think Charlotte's exactly right. I think it's those unintended knock-on consequences or the unthought through knock-on consequences. So yeah, I don't know. I mean, I'm not a huge fan of EOT. I think in the right circumstances, EOTs are amazing, but those right circumstances are quite limited. And I think actually, if anything, it is going to make it harder, because whereas somebody might have been expecting to wait 8 years for the rest of their which is still a damn long time, let's be honest, but you might find yourself waiting 10 years now because the business is paying so much more in tax costs.
And with how long 7 years that would be extended.
Doesn't appear to be anything on that.
No. I mean, I have to say, I expected a really quite wide-ranging consultation on IHT generally. So whereas it seems to be just from what I've very quickly seen, I don't think there's too much else in there from
No.
an IHT point of view. So whether that's something that will be in the crosshairs in due course, but at the moment they seem to have restricted it to just attacking the reliefs, really, to be honest.
And it's quite likely because they have said
Hmm.
in the spring statements, it's quite likely we might talk about the next month.
Yeah.
And
Yeah.
what's going to be
Yeah, I sort of worry about the plan. Everyone sort of got quite excited, but I kind of worry about the plan to not do tax in March because of the
It's not working.
well, because of the forestalling problem. So it's like, we were announced. So forestalling is that you know a change is going to happen, therefore you're going to do something about it in advance. So if you announce them in October, what happens is, like CGT, is you have to have them implemented instantaneously. Where actually, if you announce them in, the second week in March, you can probably let it roll until the 6th of April and the tax year, because the number of people who can actually get that capital disposal wrapped up and dealt with in 2 weeks is pretty small. But if you're going to say all tax changes are going to be announced in November, then actually that's a decent chunk of window for planning, essentially. On those things, we tend to say generally tax changes are best announced as late as possible, just from a sheer implementation point of view, and keep it aligned to the tax year. I guess you'll have, when you keep moving things inside tax years, it
does make really, really difficult to manage. Having said that, the old days where payroll providers had 2 weeks to adjust their softwares to the new limits, they probably say thanks for telling us in November, so it swings. But I think, but what we've seen in the last couple of months is that the threat of tax changes drives challenging behaviours. Shall we say? Let's just leave it at that. People making decisions based on imperfect information. How many people wouldn't have sold their business if they'd realised their CGT was only going to go up from 20% to 24%, as opposed to expecting it to go up to 19%?
Yes.
Exactly, because suddenly it's a buyer's market, and the buyer knows you want to get the deal done. And actually, do you know what? We might just knock £500,000 off the price. You all right with that? So.
Well, and they've also introduced 2 more buyers markets, right? Because we know the rates change again in 25 and again in 26. So
exactly, yeah.
Anyone who wants to purchase an asset, hang off until January-ish next year and the year after, and then sellers are really incentivized to get short.
I think so. Yeah. So fun times.
You've made reference to R&D and keeping it safe.
Yeah.
I know there's been quite a lot of stalling around how robust some of the providers of R&D advice have been.
Oh yes.
It's been challenged quite a lot at the moment. Callback, and obviously that's kind of making reference to callbacks from around COVID. They're going to apply the same approach to R&D. What's your kind of thoughts around that? Do you think they'll make it more? Do you think they'll provide more specific guidance? Because personally, one of my concerns would be that people now are so afraid to go and claim those things, who should really be claiming them, where they are spending and they're not, using external sources of finance to do that. They're self-funding things, so actually, it's going to really inhibit growth in the areas that they're actually trying to stimulate spending. So I think from what they said, looking at yeah, no, it says. I mean, it's kind of a bit of like a.
Well, there's nothing different.
Just a bit of a
The tax credit system's not changing, I think, is it?
R&D relief maintained.
Yeah.
There's like specific industries, which I think are the industries that are already kind of focused on, but there has been quite a lot of, I think, sort of very lax and broad interpretation of.
Yes.
That's
I mean, I'd use the word fraud, but yes.
Well, we have seen at least one business raided by the police, haven't we, in the recent past?
I mean, it's been egregious on the R&D stuff. Yeah. So I think the problem with I think expect some tightened guidance, definitely. Stuff like this is generally things that make tax economists a bit nervous. R&D. Again, there's not, a bit like entrepreneurs' relief, there's not a lot of evidence that incentivizes anything to happen. Not a lot. And certainly if they're thinking about saying, oh, actually, we really want to focus on industries A, B, C, and D, it's like, and here is your next set of tax avoidance schemes. right? Once you say, if it looks like this, we give you a bigger relief, you suddenly incentivize everyone to make their agricultural business look like a medtech business in some way. Yeah, that is it. Who knows, right? It's like, but every time you make a special case, every time you do a black line in tax law, you just create a huge incentive for everyone who's quite close to it to hop the other side.
Yeah.
And that then just increases costs for HMRC in terms of compliance and chasing everything. Let's wait till March.
Yeah, I think there's a with the whole R&D tax credit system needs to be, I've said this before, I'll say it again, it effectively needs to be scrapped and go back to a blank sheet of paper and design it from the start.
Yeah, absolutely.
Because it's, yeah.
So you have more confidence.
No, you don't want the brown envelope landing on the doormat saying, please explain. Yeah.
Yeah.
In the market that haven't helped.
Bad actors, I think they call it these days, don't they? Yeah. Oh, 100%. Yeah. Yeah.
Slowing their growth down because they're having to sell fun stuff. Kind of similar with EV as well. They talked about electric vehicles. I wasn't quite following what they were saying. I know they've changed the rules on EV.
Yeah. I think what in terms of the benefit in kind taxation, they're going to keep EVs at the same level as they've got it at, but they're going to increase the rates for non-EV company cars effectively, is what they've said. Yeah. So the EV is going to stay as, they're not going to make any changes to that. So is it 2% I think at the moment, but as they have done for years, they're going to uprate the petrol and diesel percentages. I mean, I'm not sure that I don't know why anybody would have a company car that wasn't an EV these days, really.
No, just the tax incentives are huge.
Anything else? Well, thank you both very, very much. I think it's been incredibly insightful.
Fun.
And thank you. Don't clap, throw money.
Please feel free to
Otherwise, I'll have to eat them all.
But yeah, thank you very much.
Thanks, everyone.
That's good.
Excellent.